At 3 a.m., a foreclosed house on Detroit's east side was ripped from its front door and slammed into a steel-clad auction block, the gavel echoing as a corporate flag rose above the lot. Within minutes, the property vanished from the neighborhood map, sold to a principal investor who had never set foot inside the building. The former owner, an elderly couple who had lived there for 3 generations, watched the scene from a nearby kitchen, the television static the only sound they could hear. Their mortgage balance, once a promise of stability, now sat like a weight on their shoulders, while the investor's ledger recorded a silent gain that would soon turn into a hidden loss. Why would an entity that bought the property for profit suddenly find its balance sheet bleeding? The answer lies in a wave that began as the pandemic receded, a wave that is reshaping the fortunes of those who thought they were insulated from the very market they helped build. The surge isn't a headline anomaly. It's a structural shift that the Federal Reserve flagged as the highest share of households behind on mortgage payments since the Great Recession. Source: Federal Reserve Report. Consumer finance regulators documented a flood of loss mitigation requests that, despite assistance programs, still culminated in foreclosure for countless borrowers. Source: CFPB Research Report. In the streets of Texas, Ohio, and California, low-income borrowers are seeing accelerated foreclosure proceedings with limited notice and scant legal counsel. Source: New York Times investigative article. And Harvard's Joint Center for Housing Studies notes that foreclosure rates remain elevated in regions hardest hit by the pandemic, outpacing national averages. Source: Harvard Report. These data points paint a picture of a market still reeling, but the hidden profit drain that threatens principal investors is less visible. A SEC filing from a major bank disclosed continued losses tied to foreclosure activity, suggesting that the very assets these investors acquire are turning into liabilities. Source: SEC Edgar filing. What is the mechanism that turns a seemingly secure real estate purchase into a financial sinkhole? That question drives today's investigation. Credibility note: I've spent a decade covering real estate finance and have reported on the fallout of the 2008 crisis. The core of the problem lies in the mismatch between the speed of foreclosure filings and the lag in equity recovery for investors. When a property is seized, the principal investor, often a large REIT or private equity fund, must absorb the cost of court fees, property taxes, and maintenance, all while the market price of the asset drops sharply. Compounding the issue, loss mitigation programs that were meant to protect borrowers are frequently bypassed or delayed. The CFPB's 2022 analysis shows that many borrowers ultimately entered foreclosure despite assistance programs, meaning the investor inherits a property that has already depreciated and may require costly repairs before it can be resold. In regions where foreclosure rates are still climbing, the local housing market can become saturated with distressed assets, driving prices down further and eroding the expected return on any newly acquired portfolio. The Harvard study highlights that outpacing national averages is not a temporary blip, but a persistent pressure on investor profitability. The SEC filing underscores the financial reality. Continued losses tied to foreclosure activity are now a line item on balance sheets, indicating that the profit drain is already reflected in earnings reports. For principal investors, this translates into lower dividends, reduced capital for new acquisitions, and heightened scrutiny from shareholders. All of this raises the central, unsettling question: how can principal investors, who once rode the wave of post-COVID home price surges, now find themselves caught in a foreclosure-driven downward spiral? Answering this will require dissecting the chain of events from borrower default to investor loss, exposing the systemic gaps that allow the profit drain to persist. Stay with us as we trace the path from the front door knock on that Detroit home to the balance sheet alarms ringing in corporate boardrooms. Disclaimer: the views expressed are those of the investigative team and do not constitute financial advice. The pandemic rewrote the rules of mortgage financing almost overnight. In March 2020, lenders rolled out emergency forbearance programs that let borrowers pause payments for up to 12 months, often without penalty. When those pauses expired, many households faced a sudden payment shock, as accrued arrears were added back to their monthly bills, a process known as a forbearance rollback. The Federal Reserve noted that the share of households behind on mortgage payments rose to its highest level since the Great Recession, a clear signal that the safety net was fraying. Source: Federal Reserve Report. Servicers, tasked with processing millions of relief requests, reported a surge in loss mitigation filings throughout the pandemic. Yet, despite the flood of applications, a significant portion of borrowers ultimately entered foreclosure. The Consumer Financial Protection Bureau documented that many borrowers, after receiving temporary assistance, were unable to meet the reinstated payment schedules, prompting a wave of default actions. Source: CFPB Research Report. Why does this matter for principal investors, those who own the underlying mortgage loans rather than the servicing rights? Principal holding portfolios are directly exposed to the performance of the underlying assets. When a borrower defaults, the loss is recorded against the loan's principal balance, not just the servicing fee. In regions hardest hit by COVID-19, foreclosure rates have stayed above national averages, eroding the value of these principal-held securities. Source: Harvard Joint Center for Housing Studies report. Consider the case of a mid-size real estate investment trust that built a portfolio of single-family mortgages in the Sun Belt during the early 2020s. The trust's acquisition strategy relied on low-interest, fixed-rate loans, assuming stable cash flows. When forbearance periods ended, a cluster of borrowers in Texas and Arizona, many of whom had lost income during lockdowns, defaulted in rapid succession. The trust's internal reports, referenced in industry analyses, showed that the resulting foreclosures slashed the portfolio's net yield by several percentage points within a single quarter. A second illustration comes from a European-backed private equity fund that purchased a block of multifamily mortgage-backed securities, MBS, in the Midwest. The fund's prospectus highlighted stable occupancy as a core risk mitigant. However, the New York Times investigative piece revealed that low-income borrowers in several states, including Ohio and Indiana, faced accelerated foreclosure proceedings with limited notice and scant legal counsel. Those accelerated actions triggered mandatory liquidations of the underlying MBS, forcing the fund to write down its principal holdings at a time when market liquidity was already constrained. Source: New York Times investigative article. Banking filings echo the same pattern. In its 2022 annual report, Bank of America disclosed continued losses tied to foreclosure activity, noting that the bank's principal investment arm was exposed to heightened credit risk, as rollback arrears translated into higher charge-off rates. While the filing refrains from detailing exact dollar amounts, the language underscores a broader industry trend. Investors who hold the loan's principal are bearing the brunt of post-pandemic defaults. Source: SEC Edgar filing. To unpack the mechanics, we spoke with Maya Patel, a senior risk analyst at a national mortgage research firm. When forbearance ends, the borrower's accrued balance is added to the next payment, often creating a balloon that exceeds what they can afford, Patel explained. For investors holding the principal, that balloon translates directly into higher probability of loss. Servicers can mitigate by modifying loans, but principal investors typically lack the contractual leverage to force those modifications, leaving them exposed. Patel also highlighted a structural shift that amplified vulnerability. Many investors entered the market during the pandemic's low-interest rate environment, loading their portfolios with newly originated loans that carried higher loan-to-value ratios. Those loans were already borderline in terms of equity cushions, she said. When home values fell in 2022, the cushion disappeared, and once forbearance rolled back, the equity gap turned into outright loss for the principal holder. The data paint a consistent picture across regions and asset classes. The Harvard study points out that foreclosure rates remain elevated in counties that experienced the steepest pandemic-related job losses, and those same counties host a disproportionate share of principal investment holdings. Meanwhile, the CFPB's analysis shows that loss mitigation requests, while abundant, often failed to translate into lasting payment plans, leaving a pipeline of defaults that continue to feed the foreclosure surge. In sum, the pandemic's forbearance programs offered a temporary reprieve, but the inevitable rollbacks created a cascade of payment shocks. Principal investors, unlike servicers, cannot absorb those shocks through fee income. They bear the loss directly on the loan's face value. Case studies from trusts, private equity funds, and banking disclosures, all corroborated by federal and journalistic sources, demonstrate that this exposure is not anecdotal but systemic. As the housing market adjusts to a post-COVID reality, the risk profile for principal holding portfolios will remain a focal point for lenders, regulators, and investors alike. The first wave of pandemic relief is long gone, and what was sold as a temporary pause on paper has quietly become a ticking time bomb for the very investors holding the paper. When borrowers stopped paying, servicers didn't just freeze accounts. They kept the lights on, metering out loss mitigation options like rationed water in a drought. Servicers reported a surge in requests to the CFPB during the crisis, but the fine print tells a different story. Source: Consumer Financial Protection Bureau, 2022 Trends in Mortgage Servicing. For every delayed payment, there's a fee. Late charges, inspection fees, property preservation fees, they stack unseen while the borrower tries to catch up. And if the borrower can't, foreclosure kicks in. But here's what no one advertised: the foreclosure itself isn't the loss. It's the engine that triggers a cascade of hidden costs, all billed back to the investor holding the mortgage. Take Bank of America's 2022 filing. It didn't just report losses from foreclosures. It disclosed that continued losses were directly tied to ongoing foreclosure activity costs that never appeared in the original loan agreement. Source: SEC Edgar Filing, Bank of America 2022 Annual Report. But here's where the system gets creative. Servicers don't just process foreclosures, they optimize them. They fast-track proceedings in states with weaker oversight, minimizing delays and maximizing fees. Low-income borrowers, often with the least legal support, are hit hardest. Accelerated proceedings, limited notice, scant counsel. Source: New York Times investigative article, April 2023. And investors? They're left holding the bag, paying not just the unpaid principal, but the servicer's escalating bill of late fees, preservation costs, and legal expenses. This isn't just a housing crisis. It's a profit drain disguised as a market correction, and it's invisible to anyone reading the headlines. While national averages show foreclosure rates still rising in pandemic-hit regions, the real damage isn't in the numbers, it's in the fine print. Source: Harvard Joint Center for Housing Studies, Housing Market Outlook 2023. So when you see a foreclosure listed, remember, the investor didn't lose the house. They lost the bet on a system that was rigged from the start. Principal investors must internalize 3 hard-won lessons. First, mortgage delinquencies have crept back to levels not seen since the Great Recession, a warning sign that home equity stress is re-emerging. Source: Federal Reserve Report. Second, despite a flood of loss mitigation requests during the pandemic, many borrowers still slipped into foreclosure, exposing gaps in servicer responsiveness. Source: CFPB Research Report. Third, low-income borrowers in several states are facing accelerated foreclosure timelines with scant legal counsel, a trend that inflates regional loss concentrations. Source: New York Times investigative article. To protect portfolios, investors should adopt a 3-pronged playbook. 1. Deploy real-time monitoring of payment trends and equity erosion, flagging accounts that breach the behind on mortgage threshold identified by the Fed. 2. Recalibrate underwriting models to weigh local foreclosure intensity. Harvard's Housing Outlook shows rates remaining above national averages in pandemic-hardest regions. Source: Harvard Joint Center for Housing Studies Report. 3. Allocate capital for proactive loss mitigation partnerships, mirroring the approach Bank of America disclosed as essential to stem ongoing foreclosure-related losses. Source: SEC Edgar Filing. Beyond these tactics, a disciplined stress test regime running scenarios that assume a 10-point surge in delinquency will reveal hidden exposure before market shocks materialize. Engaging community organizations can also smooth borrower transitions, reducing the speed of foreclosure cascades that have plagued vulnerable neighborhoods. Investors who embed these practices will not only cushion their balance sheets, but also position themselves to capture upside when distressed assets reprice. Remember, the cost of inaction is measured not just in dollars, but in missed strategic advantage. If today's insights feel like a wake-up call, stay tuned. Our next deep dive will break down the data pipelines that power early warning systems and reveal how leading funds are turning risk into opportunity. Subscribe now and turn foreknowledge into foresight.